Okay, so now that we have, and again, I'm skipping here just some of the work. So I showed you the steps, but I'm skipping a bunch of the work so that we can keep these videos short enough that you guys will actually watch them. Okay, so I pulled down 3 years worth of data here, and we talked about how some of this data gets condensed, right? So here was the strict copy from 2010, and we talked about how the financial receivables and the income tax receivables got combined into other current assets during the 2011 year. So we already know that some of the data that we end up with is going to be more condensed than maybe we even need. So that's one of the things that we always got to be careful for or careful about when we're looking at these consolidated financial statements. Is that, for instance, we already know here that other current assets contains several items that might be relevant to us later in the analysis. Okay, so again, typically what we're going to do is we're going to collect, say, 10 years of data. So we might start in 2011 and then collect data all the way to, let's say, 2020. Or we won't be able to get 2020's data, actually. So we'll collect data at 2019. So we might go back a year to 2010, and we would collect historical data here. Right. So again, this is step one. We're analyzing the historical performance of the firm. Now, part of that is we'd like to look at the breakdowns, the trend lines within the numbers themselves. So within the income statement, we're going to look at how the costs of the firm have changed, and we might use one of the say margin analysis from the slides. We looked at like a graphical representation of UPS's margin of basically this part of their income statement, and we noticed a few things, namely that over time it looked like purchase transportation has been increasing significantly, that fuel costs have been increasing significantly, that compensation and benefits stayed pretty steady. So again, we're looking to analyze the historical performance of the firm. We're trying to understand how the firm has been behaving, and hopefully that will help us understand how the firm is changing over time, right? The firm isn't static. And we'll talk about some ways that UPS is changing. So we collect all this data, right? These are the actual accounts. The second part of analyzing historical performance is to reorganize the financial statements so that we can calculate the value drivers for the firm, right? So once we have all the historical data written down or copied down, what we're going to do is we're going to reorganize the financial statements so that we can calculate NOPLAT and invested capital, where NOPLAT comes entirely from the information in the income statement, and invested capital comes entirely from the information in the balance sheet. Now, I'll do that here on a separate tab. Right, so we're going to reorganize, and I've already laid out the structure of the reorganized statements, and of course this wouldn't, in practice you probably wouldn't do it like this, because you wouldn't know what the reorganized statements were going to look like. But the central function or the central goal of reorganizing these statements is to pull everything out of the consolidated financial statements that is operating in nature, and put it into a new financial statement, or a new income statement, a new balance sheet that is only going to contain the operating items for the firm. Okay, and it's kind of a tricky thing, and so I think the best way to go about identifying these is to sort of walk through each item one by one, and then just color it, put a star next to it if it's operating in nature. Okay. So we're going to walk through each one of these items and we'll say, okay, is this operating? Is this necessary to UPS operating their business or not? Okay. So we'll start at the top. Let's just start with the income statement. We'll start with revenue. Boom, revenue, absolutely relevant, right? There's no way to get around revenue being a operating item. Now, it's true that there are, in the consolidated balance sheet, there is going to be income here, revenue, that is possibly not operating, right? So there could be some revenue consolidated into this item that is not due to UPS's shipping business, that it's due to some other thing. And a lot of times they will list alternate revenue sources here, or say here. For instance, we've got a revenue source that's called investment income, right? So this is income from UPS's any equity investments that they make. So they own some stock, they get some dividends from some shares, and it's pretty sizable. These are millions, right? So 20 million in 2013 in terms of investment income, but that is not central to the operations of UPS, right? So sometimes it's broken down, but sometimes it's not. So it's certainly true and potentially likely that there is some income contained in revenue here that isn't operating in nature. Now, if we're inside the firm, we have the ability to break down revenue and to separate the operating revenue from any non-operating revenue. If we're outside the firm, we are unlikely to have that potential for us. So we just go ahead and assume all the revenue is operating unless we know better. Okay. Compensation and benefits. This is all the money that we pay our employees. So this is absolutely operating in nature. We need our employees to run the firm. This is the compensation that we pay them and the benefits that we promise them. Purchase transportation, right? Purchase transportation is sort of a central function of UPS's business, and it's maybe not something that you've ever thought about before. But UPS pays a significant outlay. This is a significant cost, right? So these are millions. So this is $7 billion in 2013. That's a huge chunk of cost there for other people to deliver their packages. And mainly what this goes out to, and I know this because I've read the financial statements. We would know this because we would have to read the financial statements. You go read the financial statements to find out what purchase transportation is, but this is mainly due to a policy that they have with the U.S. Postal Service called the last mile delivery, where UPS has found that it's cheaper for them to deliver a significant chunk of packages, especially in rural areas, from their warehouse in their major distribution area, so in a big city, to the local post office in a more rural area. And then the post office is the one who delivers the last segment of the package, meaning from the post office to the house. And they call that the last mile delivery. And so they pay the post office for this, obviously. And this is what purchase transportation is here. They are spending a significant amount of money to get these packages delivered by the post office the last step of the way. So UPS does the majority of the sort of long distance shipping, and then has phased out sort of the direct to home shipping, or some of the direct to home shipping. So this is why sometimes if you order something and you thought it was coming UPS, it ends up at the post office. And FedEx does the same thing. They will just deliver to the post office to save themselves the delivery cost of going house to house. Right? Fuel. Now, of course, fuel is something that's probably relatively unique to a company like UPS. You can imagine if we were, say, looking at the financial statements of a company like Hasbro, the toy maker, or Electronic Arts, the video game maker, that neither purchase transportation or fuel is going to be on their income statement. And if for whatever reason it's not likely to be an operating expense. Of course, I can't imagine why it would be, but what I'm trying to point out here is that the process that we're doing here is not something that can just be cut and pasted into another firm, right? So we're walking through and we're thinking about whether these items are operating in nature for UPS specifically. But if I pull up the financial statements for Electronic Arts, not only are their statements going to look different, they'll be consolidated in different ways, but the items, the costs and revenues that are listed are, even if they're the same, they may not be operating in nature, and they're, of course, they're unlikely to be the same, and so we'll be looking at different kinds of operating items. Okay, so this isn't this process is more of an art, or is as much of an art as a science, and we have to really think about each item here and understand it in the correct context. Okay. So fuel, UPS is in the business of delivering packages all over the world. Obviously, fuel is both a major expense and an appropriate operating expense for the firm. Depreciation. Okay, depreciation is operating in nature. Depreciation is what we have to be careful with here is that although depreciation is sort of part of the normal operating of a firm, it is a non-financial, or maybe a better way to say it is a non-cash expense, right? So depreciation is just an accounting expense here. So when we calculate our net operating profit and our gross profit, we are going to have to remove the effect of depreciation. So while we do recognize that depreciation is part of the normal operations of the business, in the sense that a firm depreciates its assets over time, in terms of replacement cost. Just as a quick aside, because I'm not sure whether you guys have thought about depreciation in this context. Depreciation is often taught in the context of trying to match the revenue and the cost of an item, right? So we buy an asset like a truck, we spend all of the cost at once, and we earn the revenue from that truck, or we generate revenue from that truck over time. So accounting rules let us depreciate the asset over time so that we spread the cost out. And by spreading that cost out, we more closely match the cost occurring over time with the revenue occurring over time. Now, that doesn't change the actuality of the transaction, which is that when I buy a truck, I spend all of that money all at once. So there is no sort of depreciation is not the way the truck is bought. That's why it's an accounting expense and not a cash expense. We pay for the truck up front. We are just allowed to sort of, in accounting terms, spread the cost out. But in financial sense, one of the other ways that we think about the effect of depreciation is because depreciation isn't a cash expense, and because the company is not actually spending $1.6 billion in depreciation, that's, again, it's accounting, it's not cash. But one of the things that we can think about this in terms of financial health of the firm is that the company should be recognizing that as it's depreciating assets, those assets are slowly getting wear and tear. They're becoming less valuable. They're becoming less useful. And so an ideal way that the company can use depreciation is as a sort of pseudo savings account that it can keep putting money into in order to save up for the ultimate need to replace the assets that we're depreciating. So I'm depreciating this truck over 5 years. After 5 years, the amount of wear and tear on the truck means that I need a new truck. I've just totally worn it out. And if I was smart, if the company was acting in the best interests of its shareholders, then it would be putting the depreciation into a savings account, more or less, so that by the time it came time to replace the truck, it would have enough money to replace the truck, and it would be able to buy a new truck and then start the depreciation process all over again. So one of the ways, and the other ways that we think about depreciation is as a replacement cost savings account. Okay. Now that doesn't mean that the company actually does that, or that they do, that they treat it that way, but we definitely think about it that way. And so certainly we treat depreciation as operating in nature, even though it's non-cash. Now, amortization is the same thing as depreciation, only amortization is for intangible assets instead of tangible assets. So depreciation is how we spread the cost the cost out of a tangible asset like a truck. Amortization is how we spread out the cost of an intangible asset like a brand. Okay, so amortization is a way that we treat it. This specifically, and again, notice that there's also amortization down here, and this says amortization acquired intangibles. So note there's two different amortizations listed here, and that's because this amortization up here is specific to something called capitalized software. And again, we would have to read the financial statements to figure this out, right? So we would notice these two things on their consolidated balance sheet, and we would say, why have they split off this amortization from the amortization of acquired intangibles, and why have they moved it above EBITDA, right? And the reason is because UPS has a software system that they use. They treat it as a significant part of their business. They view it as a significant part of the reason that they're so successful. It's a proprietary software system that helps with the logistics of running their business, right? So it's the thing that is determining how the packages get sorted, how they get shipped, how they get delivered, what trucks they go on, what order the trucks go. This whole system is the reason why UPS thinks they're so successful. And because of that, they have what's called capitalized this software. And capitalized means put onto the balance sheet. They treat this software as an asset valuable enough that they list its value on the balance sheet, right? So even though software is intangible, you can't touch it or hold it. They consider it to be such a valuable part of their business that they list it specifically as an asset on their balance sheet. Because they do that, they then treat the amortization of that software, similar to, say, the depreciation of all their trucks and planes, as a operating expense, and they move it above EBITDA. Okay. So again, remember that EBITDA is earnings before interest and taxes and amortization, and that's this amortization down here. And they are UPS is breaking this off specifically because this intangible asset has been capitalized. Okay. Now, operating expenses or other expenses. Now, this is sort of let me put like neutral here, because what we want from this is only operating other expenses. But ultimately, what we would do. Again, I don't want to make these videos into like 5-hour affairs. So ultimately what we do is we'd go find the table that other expenses references here, and we would find the breakdown. So we'd be looking for some table that said, footnote 1, other expenses, and then it would, list 1, 2, 3, 4, etc., and it would tell us what those other expenses are. And what we'd be trying to say is, okay, this expense is that's operating, this is expenses operating, and we would come back and we would say, okay, of the $6 billion in other expenses, only 4.5 to 8 billion are operating, the other are non-operating, and so we would just enter a new line here where we'd say other operating expenses and other non-operating expenses, and we would separate that out. One of them we would highlight as operating, one of them we would highlight as non-operating. Okay. Again, you would just find that table somewhere in the footnotes in the financial statements. They're going to break that down. Okay. And then we just keep going. All right. So amortization of acquired intangibles, this is not operating. Okay. So I'll mark that as red here. Amortization of acquired intangibles is mostly first, acquired intangibles means the difference in value between when I buy a company, what I pay for it, and what it's worth. Okay, so it's fairly common for, say, a company of the size of UPS to buy a smaller firm, and they would run a DCF analysis like this on the smaller firm, and they would identify the enterprise value of that firm, and that's what they should be willing to pay for it. Then there is typically a premium paid on top of that to compensate the shareholders of the firm you're buying for selling, right? They want to sell for more than it's worth. That value is has to be included on UPS's balance sheet once they've done it. And the way that that value is included on the balance sheet is as what's called an acquired intangible. They might say, we paid for the brand, we paid for the workforce of the company. We anticipate that there will be significant increases in value because of this. So there's a reason we paid for this premium. And because we paid for that premium, we have to list it on our balance sheet. We list it as an intangible asset, an acquired intangible asset. So that is not a part of UPS's operations, right? Buying other firms isn't part of our normal operations. Our operations are, we are a delivery company. That's what we mean by operating expenses or revenues or assets. Unless your company is actually engaged in the operations of buying other companies, like say Warren Buffett's company, Berkshire Hathaway, they're a holding company. Their entire business is buying other companies and then running them. So then, of course, that's operating for them. For UPS, it's not. So we amortize those intangible assets. It has the same definition as this kind of amortization, but this is operating in nature. This is non-operating in nature. Severance and other restructuring charges, again, not operating here. Severance is paying employees that we've had to fire. And when it's included here with these other restructuring charges, and notice that there isn't a charge in every year, what we are expecting is that their UPS had to close down some kind of plant or factory. They closed down some kind of sector of their operations, and in doing so, they had some restructuring charges, meaning they had to sell the equipment or whatever. And the severance is they're paying all the employees that they fired from that. And that actually ends up being the case here in 2012. They closed down, I think, their South African operations in a significant way. They reduced a huge number of their employees there. And so the severance charges here are them paying these employees. Now, this is not typically considered operating in nature because, of course, even though it's sort of part of the operations of the firm in terms of they're, sort of constantly managing their employees and workforce across the world, the severance charges is not something that we consider to be part of their normal operations. So we won't include it. Gains and losses on asset sales. This is UPS either selling an asset that they own for more than it's worth, right, which is then a positive amount, or selling an asset that they own for less than it's worth, so they've taken a loss. And again, UPS isn't in the business of selling assets. They're in the business of delivering packages. So this isn't an operating item. Pension adjustments. This is, in my mind, the rule of thumb is that this is not operating. Okay, so pension charges aren't operating. To my mind, I sort of disagree with that. I have a little bit of disagreement here because pension charges the pension is what UPS had promised its retired employees. They had promised to pay their retired employees a salary, a pension, until their death. That was their retirement plan for a long time. Now, most companies, older companies, had pensions. Most companies these days don't have pensions anymore. They've all switched to individual retirement planning, and you'll get a 401k. So these pension adjustments is money that has been promised to their ex-employees. Right? Now, that's why the rule of thumb, the general wisdom, is that this isn't operating in nature because these are no longer employees. But my feeling is that, and again, this is just a little soapbox that I have. But my feeling here is that these that what you have promised your ex-employees is very much a part of your operations because you promised that as part of their compensation and benefits while they were your current employees. And so any current employees that are participating in the pension plan or the retirement plans that you currently have, this is parcel of why they're working for you. And it's part of the compensation that you are promising them. And just because it happens after they're your employees, doesn't, to me, change the nature of it. But That being said, we stick with conventional wisdom, at least for now. Okay. Operating lease interest. All right. This is an operating lease is, and we'll talk some more about this, especially because the laws have changed. So I've got some. When we get to this chapter, I've got a couple of Wall Street Journal articles posted for you guys about these law changes. But an operating lease is what happens when UPS is leasing some of the assets that they use in their normal operations, right? So typically what this is, and this is what it is for UPS. We actually we saw a footnote here when we were looking at the financial statement for 2010. Typically what this is what's called a sale leaseback agreement. And for UPS, what that meant is they used to own the planes that they, all of the planes that they used to deliver their packages by air. And they decided that they didn't want to hold those planes on their balance sheet. It was too expensive. And they didn't want to have the debt that they had purchased the planes with on their balance sheet. So they didn't want the liability on their balance sheet. They didn't want the asset on the balance sheet. So what they did is they sold the plane. They used the proceeds of the sale to pay off the debt that they owed on the plane, the loan that they owed on the plane. But then because they still needed to use the plane, they then leased the plane back from the buyer. And this is called a sale leaseback. So you sell the asset and then rent it. You lease it from whoever you sold it to. Okay. And because you're doing that, because this is now essentially a rental transaction, you are going to have rental expense, and this gets complicated quickly, and we'll have a chapter where we talk about this more. So I won't spend a huge amount of time here, but this is not looked favorably upon in terms of a financial analyst trying to value a company, because it artificially decreases the value of the assets and the amount of the liabilities on the balance sheet, because they would have had additional assets and they would have had additional liabilities. And by moving these assets off balance sheet, they have increased the return on invested capital for the firm because they've decreased invested capital. And so it is often seen as a way to sort of artificially make the firm look better than it is. And so one of the things that we might try to do as analysts is move these items back onto the balance sheet, put them back on the balance sheet as if they still owned them, because they're still using them that way. And so we'll talk a little bit more. This maybe was the wrong time to start talking about that, but that's what operating lease interest here is. We have tried to treat the operating leases as if they were still planes that we owned on the balance sheet and loans that we were still paying. But these are not operating in nature because they are essentially loans that we have. The amortization of past sale leaseback gains. Now, we don't have any of these items. This is purely here. And again, this is not operating in nature, but it's purely here because it's an item that FedEx has. And so when we're comparing FedEx and UPS, for me, it's helpful to make their consolidated statements have the same items. And so that may mean that you put in an item for UPS or FedEx, alternatively, that isn't in the other one. And so this is one of those items. UPS doesn't have any of this, but FedEx does. So that makes it easier for us to compare those two balance sheets. Okay. Now, interest expense. This is the interest that we pay on our loan. This is not operating in nature, or rather, maybe it can be considered operating in nature because we're using loans as a way to finance our business, but we separate the value of the financing from the value of the operations. So when we're doing this, we are imagining that the company gets the money from the money tree, and we're not considering where the money came from to run the business. Okay, so we want to just analyze the operations of the firm. We will analyze the financing of the firm in a separate step. Okay, so we are going to consider interest expense and any other financing expense as not operating in nature, but only because we'll value them in a separate part. So we'll value the operations of the firm separately from the financing of the firm, and then we'll use those to consider the entire firm. Right? Now, investment income, I talked a little bit about this. This is money that UPS has made from their equity investments. They own chunks of other firms, and because they own chunks of other firms, they get a share of the profits by getting a dividend. And so this is likely to be income from dividends from the stock holding that UPS has. Again, UPS isn't a stock trading company, so this isn't operating in nature, even though it is income. They don't have any other income expenses here. They might. And then income tax is again, it's one of these, maybe what we're looking for is what's called the operating cash taxes paid. Okay? So we are going to have to recalculate taxes in a separate, as a separate part. So we're looking for the operating cash tax rate. What we're going to do then is to take all of the things that we've highlighted as operating in nature or potentially operating in nature and set them equal to the cells over here in our reorganized income statement. Right? So we'll set this equal to revenue. We'll set this equal to compensation and benefits. We'll see if we can drag all that down. There we go. We will pull all our values in over here. I'm going to reformat all of this to be accounting. We are going to have to calculate operating cash taxes separately. Again, we're going to have a whole class on this because this isn't it's not trivial. We'll have to go into the income tax tables and calculate what's called operating cash. The operating tax rate, and then find the operating cash tax rate. I'm just I'll sort of gloss over that for a little bit. We'll calculate EBITDA rather than dragging it, just to make sure we get our numbers right. Okay, so there's our EBITDA. We will multiply this by the operating so we'll multiply this by the operating tax rate to get operating cash taxes. And again, I'm not going to go into huge detail here because we will do this in a lot more detail in a later class. So I'm just going to show you what it is. And then NOPLAT is net operating profit less adjusted taxes. EBITDA is net operating profit, and we know that because we have identified only the operating revenues minus our operating expenses. Right? Less adjusted taxes. Adjusted taxes means we want the operating cash taxes, and that's how we calculate our NOPLAT. Right?